Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you Wednesday, November 4th, the year's 2020. Let's talk trading. The reality of trading, cold, hard truths, part 7. Yeah, we're going to stick with the cold, hard truths. Walmart couldn't be here today, but there's still plenty more cold, hard truths to go over. And I guess this isn't a cold hard truth, but it's a truth that these videos are for educational purposes only, and your results may differ from mine. And trading is extremely risky. You can lose all of your money. So if you need trading, investment, or financial advice, seek the advice of an accredited financial professional. One of the cold hard truths about trading, and I may have mentioned this before, but it's worth repeating. Most of what you see about trading really isn't so. It's really not reality. Somebody asked me about support and resistance. And my response was it's conceptual. Because anytime there is an opinion, it's not real. It's just an opinion. You know, because if it's a fact, it's a fact. It's not an opinion. So when you talk about support and resistance, one person says, well, it's here. Somebody else goes, well, it's there. Well, obviously, it's an opinion, and therefore, it's conceptual. And so when you see all this stuff out there, that's something you have to be able to discern is whether or not something is real. You know, Walmart and I use different brokers. And since Forex isn't a consolidated market, my daily open line and his daily open line are usually not the same. But it's not an opinion because for me, that's the daily open. On my broker, that's the daily open, and on his broker, that's his daily open. So you use those lines as reference, those because those lines don't move. Previous days high and low. Once again, we have two different brokers. There could be off by as many as 10 pips, but on our charts, those lines don't move. So when price crosses the line on my chart, it is crossing the line on my chart. When it crosses the line on his chart, it's crossing the line on his chart. There's no debate, there's no discussion. If he looks at my chart, he's going to come up with the same answer as I do for the daily open and previous days high and low. And if I look at his chart, I'm going to come up with the same answer as him because I'm looking at the same thing he is, the high and low. Now, you say, well, what's the difference between that and versus something like support and resistance? Well, the difference is, once again, you can be looking at the same chart on the same broker, and one trader says, well, here's support and resistance, and another one goes, oh, no, here it is here. But it's opinion. It's not. But the daily open price, that's something written in stone. All traders know what that is on that same broker. And so, the main thing about trading is you want to make a profit. You want to make money. You want to enter a trade and leave the trade with more money than what you started with. But that doesn't always happen. And because that doesn't always happen, it's because that's why we have a stop loss. Sometimes you get in the trade and from the get-go it moves against you. Once again, when you in Forex, when you start in a trade, you start out in the hole. The reason you start out in the hole, either you're going against the spread, you're going against the commission, or you're going against both. And that's just a cold hard truth. And sometimes you never see green, so you make sure that the red is within your risk parameters. Now, I present different systems, and the cold hard truth is the systems are not profitable. The trader using the system is profitable because, one person can trade this system and make money and the other one can trade it and not. So it's not the system. How do I end my videos? It's not what you trade, it's how you trade it. So right here, we're looking at the weekly chart, and you see here on the dashboard all the gaps filled. And you can see price has made a lot of movement here. We're 110 pips off the low, 175 pips off the high, and 45 pips below the open. A lot of movement. And you can see what happened here. We have the opening day or the opening range for the year, first day of the year. Here's the first day of the week, which is also the first day of the month. But you can see price got into that open range and came back out. And you see price got in this opening range and came back out. These horizontal line trades, week after week, day after day, week after week, month after month, you can see how they can be profitable. But you have to trade what you see. You have to be there to see it. That's a cold, hard truth. I mean, there's those traders that want to, just put a trade on, walk away, not pay attention. And I presented one system, how to do that. And I'll probably present another, but, I already showed you about fading the pivots. But you can also, let's see if I bring up the chart here, 282 pips below the yearly open right there. And then we've got the inside bars trades here. A lot of monthly inside bars. There's a few on the day that we can take advantage of. And you can see right here, we're in the inside bar from 3 days ago. Inside bar from 7 weeks ago. And we're in the inside bar from a month ago, last month. So right now we're in a triple. And because yesterday was election day and the elections aren't over, you can see the range here. So it's just some crazy, crazy ranges. And in fact, the pound is leading the pack here at 225. That's interesting. But you see here, you got the daily previous day's high, previous day's low. You can put your orders, a buy here and a sell here, and you can do this day after day. You see here, so it broke this line today. Looks like it would have been 50 some pips. Yesterday it broke this high. The day before it broke the low. Day before that it broke the low. Day before that it broke the low. Here it broke the high for just a little bit. So as you can see, a simple daily previous day's high-low breakout. Nothing sexy or glamorous. You don't even need any indicators. You can just pull up a daily candle on your chart, and usually right before the day closes, you can see what the high and low were going to be, and you can just put your pending order there and kind of walk away, and you put your take profit and stop loss and see what you get. Or you could set an alert, maybe have a text message go to your phone or to your email, and you could see like, oh, I'm up 5 pips on that trade, or I'm up 10 pips on that trade. Maybe I should do something. Or maybe you just put in a 2 or 3 pip profit. Say, hey, if it triggers, I just want 2 or 3 pips. Maybe you're trading $50 a pip or $100 a pip, and it's just something you do on the side. Of course, your results may differ from mine. but it's something you can consider. And see, that's another one of those cold hard truths. Sometimes the simplest systems, the simplest methods can be the most profitable. But on the other hand, another cold hard truth is once you put that trade on, the reason you entered has no bearing on the outcome of that trade. You know, when you use statistics, and somebody was asking me about statistics, but I just saw I didn't really digest the question, so I'll have to get back in and maybe answer it in an upcoming video. But the fact of the matter is, all the statistics really do, if you think about it, is it gives you the confidence to take the trade. Because you're going, well, based on statistics, I'm going to win 7 times out of 10 or, 98 times out of 100 or something like that. It just seems like I've got a good chance of winning if I take the trade at this line. And that's all statistics do. They just give you a look in the history saying, if you do this, it should work out in your favor. It might not, but if you trust the statistics and you enter the trade when you're supposed to enter in the direction you're supposed to enter, with the right position size and stop loss to stay within your risk parameters, you should do okay over the long haul. But just keep in mind your results may differ from mine. Buy zone. I mean, every day price has to move away from the daily open. It just has to. And it has to range. You can see here, we've got a 20 pip range, 10 above, 10 below the daily open. And what did price do? It broke out here, it broke out there. And you don't even have to fade the pivot. You could just take the breakout. Pivot, fade just gives you, once again, a little extra confidence saying that chances are we're going to hit that pivot. And guess what? It did. Rat traders. Now, the rat zone's dynamic, meaning it changes as the current daily high and current daily low change. So if price were to make a new low down here, this zone would move down. If price would make a new high up here, this zone would move up. But you can see here, a little while ago, the green rat started feasting. And they feasted once here, and as you can see, we made a new low, and they feasted again. And if you notice right here, right here, you can see price rejected off of this area once again. And as you look to the left, you can see price didn't even get into any of these wick zones. So, and then it turned. So it came out of this wick zone, didn't make it, looks like it didn't make a new low there on that M15, and then turned right back up. And once again, we took out the pivot. Okay, on the week, we took out the pivot. I think I called that Sunday to look for that. And we missed the pivot yesterday by a hair. A 2 pip miss. Now, those are some statistics. So, just another set of cold hard truths. I hope you take notes. I hope they're helpful. And just remember, when you're trading, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is TheRumpledOne, over and out.